All right. All right, everybody in the Code 3 community, we're thrilled to have you back on another video. Today I'm gonna spend just a little bit of time going over the stock market, bond prices, debt, and the Fed's balance sheet. But we're not going to get way in the weeds. We're not going to use anything confusing like economists may use. Where the whole idea is here is to bring information to you guys so you can make decisions in your own portfolios, your own lives. And again, the goal is always to protect generational freedom. And I'm going to tie all this together right now and show you a few kind of high level things so you can make your own assumptions on where you think the probabilities are, or the best probabilities are regarding what's going to happen coming up here. So I want to start off with showing you a couple charts here. Let's see. Let me share my screen with you. Okay, the first chart we're going to look at is we're going to look at there's a chart here with the 10-year, the 2-year, and the 30-year treasuries on it. So make that a little bigger so you can see it. Essentially, these are just, well, as you guys know, they're bonds or treasuries. Bonds are debt. So just think of it that simple. It's an IOU. And if you look at it, a lot of us were taught to save money growing up, save, 10, 20%, whatever of your earnings. And Robert Kiyosaki says savers are losers. He's not talking about philosophically you're a loser. He's talking about mathematically you're a loser. And this is why. If you look at, we have had 40 years of declining interest rates, steadily declining. I mean, that is just a steady downhill trend. And bonds used to be the um, kind of the safe place to put your money. Back then you could make pretty good yields, and nowadays you just can't. In fact, when you put inflation on top of this, if you're at 2.4%, you got a 4% inflation, you're negative 1.6. So it's very, very difficult to be a saver in this environment. In fact, mathematically, it just works against you. But I just wanted to show 40 years of downward trend in debt, or I'm sorry, in interest yields on the treasuries, which is the debt. So that brings us right to government debt, and this is going someplace. Everybody knows we've passed 30 trillion, but if you look at government debt, you'll see, and if we went back a little bit further, you'd see kind of a hump there around the 90s. It's nothing like this. It would look more like a slight knoll, but all of a sudden we get into here and the debt goes parabolic. And notice right here, this is the great financial crisis, and you just see it spikes right there because the Federal Reserve started doing quantitative easing. We started bailing everybody out, and because if you haven't spent any time studying um, the great financial crisis, you might check out the book "All the Devils Are Here." That really does a great job painting the picture of what happened there, starting in the '70s and what happened in the financial machinery all the way up to the crisis. But my point is, the debt goes very aggressively up after '08 when we started bailing people out. And then if you look here at COVID, this is COVID right here, and it just goes vertical. And I want you to notice the difference, how much bigger of a response this is on a chart than '08. And this thing, if you go back and study this, at the time I lived in an environment that we pretty well watched it on TV. I mean, we were starving for workers. It was a great economy here. We didn't really experience what most of the world experienced at that time, but what I've learned is this was a major, major event, and I mean, this could have been a worldwide depression had they, the central planners, not done various things, and it was all relative to a collapse of various things, the bond market essentially, and the financial machinery. So, and the plumbing of the system. But you'll just notice the debt goes crazy high here, and I want you to just to notice how much bigger of a response it is here than here, and this is noted as a very, very large historical event. So now with that, look at the Dow. Look at the Dow Jones over, what are we talking here? 40, almost 50 years. And you'll see that pretty steady. I mean, this is pretty stable for a very long time till we get up in the 2000s. And if you start to understand how the plumbing and the Wall Street machinery started changing, especially in the late 80s, 90s, up through the 90s and early 2000s, as it related to um, the way they got into subprime mortgages and started um, hypothecating things through here, a number of bonds and repledging debt and recollateralizing debt and selling that through the markets. You'll see why that's happening. But the red line on the bottom is just a volatility measure. So you'll notice that if there's a peak here, there's a valley here. So this is saying high volatility, and this is evidence of the downward market. So this is the '08 financial crisis, and you see how we're seeing high volatility and a downward trend. But then the stock market pretty much started taking a pretty steady climb for the last, what would that be, 14 years or so. But what I want you to pay attention to, everybody knows of the COVID. Okay, we all know of what happened here, but I want you to pay attention back here in 18. We'll start to see from sorry, when I move my mouse up there, kind of puts that block there. It's hard to see, but you'll see that this. I mean, yeah, there's some bumps in here, but it's fairly stable. Then we start getting into some big peaks and valleys right here. And what you need to know about this period of time is we started seeing higher volatility. This is back in the fall of 18, coming into 19, so way before the illness. Is what was happening is the Federal Reserve, this is their balance sheet, is they were trying to taper off right here. Okay, look at these dates back in 18 coming into 19. They were trying to taper off, and they were saying they were going to try to return to some degree of normalcy when they started quantitative easing, because quantitative easing didn't used to exist. This happened back in the great financial crisis. The Fed loaded up their balance sheet, just meaning they funded a bunch of the debt instead of the private sector doing it. They just created the money and put it on their balance sheet. Simplest way to put it. So it goes up. Look how big this is comparative to this. I mean, this is insanely larger compared to this greatest event in world history at that time. But my point is this: steady growth of the balance sheet, and then the Fed says, "Okay, we're stabilized up here. Let's start tightening. Let's start offloading the balance sheet." So in other words, they're selling some of those bonds and some of the assets they held on their balance sheet back into the market, and they're trying to unload it. And you'll notice this is what you hear in the news as a taper tantrum. Is they started to taper. Look what happens. You start to get this tantrum here. You start to get volatility. You start to get spikes in the volatility. So what did they do? Well, if you look at what they did, this is this is COVID here. This vertical line. So if you look at here, we're still back in the fall of 2019. We started loading the balance sheet up again. So in other words, they reinitiated quantitative easing. They started stepping up their asset purchases again so that they could put more debt into the market, more easy money, if you will, into the market so that the stock market would calm down and it would continue steady growth. So if you look at 40 years of declining interest rates, and this has been the last, 20 years of activity here, very low interest rates, and you see what that's done in the last 20 years, the stock market in particular, the last 14 years, it it's clear where the money's come from. Is the stock market, I mean, for years and years and years, very, very steady, pretty boring, and then all of a sudden it just starts going bananas. I mean, when you've doubled the value of that market in the last whatever 6 8 years, something like that, that tells you a lot. And it's not due to a strong economy. It's due absolutely to debt. And this is the evidence of it. The debt is right here. It's on the balance sheet of the Federal Reserve. It's just insanely high through this period of growth over the last 14 years. And then when the illness hit, obviously we loaded everything up. They're buying 120 billion a month, and easy money showed up, low interest rate environment here. And my point of that is this: if when we started offloading the balance sheet, because takes us into current time, the Federal Reserve is talking about the Federal Reserve's talking about not only doing quantitative easing, lowering the amount they're purchasing, but stopping the purchases, stopping putting these assets on their balance sheet, and start tightening, start offloading the balance sheet, and then also raising their funds rate at the same time, their interest rate. Well, that's a lot of things to happen at the same time, and frankly, that's probably what's needed to slow inflation. There's just too much, just an insane volume of easy money circulating around out there, and that's what's caused all of this inflation. It's human reactions to things. And so what they want to do is they want to slow the easy money and choke things down. But the problem is, you'll notice we've only been able to exist in this world because we've been able to stay in low interest rate environments. So if the cure for inflation is higher interest rates and less easy money, as illustrated here, less of this, well, if that's what got us this exponential growth, you have to ask yourself, what are the probabilities we start to see this volatility spike when they start dropping that down? Because right now people are, it's a political year, and politicians, I'm sure, are calling Jerome Powell saying, hey, we can't get reelected when inflation, we're reporting inflation at 7.5%, when real numbers, if you took away all the smoke and mirrors, is well into the double digits. People are hurting, workers are hurting. So they're saying, okay, well, we can do these things. We're probably going to have to raise interest rates, stop our purchases, start some tightening. But they know that this is all debt and easy money. They know that's why that stock market is what it is. And they know that that's also going to cause problems when it starts to become too unstable or fall. The phone's going to ring and they're going to say, hey, we got to make you got to stop doing this too. They really can't do both things well at the same time. So I agree with some others. I'm not saying this is going to happen, but I'm not going to be surprised as you get later into the year here if you start to see some calls for price controls like we seen 40 years ago or so, 40, 50 years ago, whatever that is. And where the government starts mandating price controls so they can step up and say the politicians are the ones here to help you. My point is this to freedom. Well, I guess before I do that, right here is a great example of that. Vulnerable Democrats call for gas tax suspension amid rising prices. So they're already saying, "Hey, we're going to have a hard time getting reelected. Let's suspend the gas tax, which funds road maintenance and so forth." And they're saying, "Well, we'll fund that from somewhere else," which just means debt. But my point is this: they're willing to do this now, and I think we're starting to see this narrative grow. I think you're going to see more discussion of price controls potentially coming this year. I think the probability is growing because the pressure is mounting on the central planners that control all this machinery. So and you can kind of see, I don't know if I spent a lot of time on that, but you can kind of see that debt there, a little bit more zoomed up. I mean, it's all debt. This is all circulates through the economy, gets caught in filters, ends up in asset prices. That's why we see um, housing prices through the roof. That's why we see multifamily through the roof. That's why we see stock markets through the roof. I mean, it's just it's not a reflection of a good performing economy. If you look at all these charts overlaid, it's pretty obvious. How does that tie to freedom? Well, look at what's happening in Ukraine right now. Germany's scared to death what's happening in Ukraine because they rely on them for natural gas, and Russia controls the pipeline. Russia can say, well, it's the dead of winter. Let's just choke the pipeline down. We'll make you uncomfortable. That's human. That's just human control 101. It's not a political statement. It's been around since the start of time. In the tactical world, which you know that I have background in, if somebody's barricaded in a place and they won't come out, we don't go in there and force a gunfight. We simply change their environment to where we put some pressure on them. It becomes uncomfortable and they choose to come to our environment that's more comfortable. That can be done through, various chemicals and gas and so forth. But my point is you squeeze on them a little bit. Well, here's the deal. The only reason the stock market's through the roof, the only reason that all this hasn't been between 2008 and the illness pandemic here, in 2020, the only reason it didn't end up in worldwide uh, total depressions based on how they reacted is we just pumped up the balance sheets. We just took more debt. We just put more easy money out in the market. So if we start to retract that, you have to ask yourself, with it being this big, if we start to retract that, what's going to happen? Well, probably going to have some instability. So that's going to require the central planners to do more. And that's how you start to subject yourself to their control. If someday, and I'm not saying tomorrow, I'm not a tinfoil hat guy, but if someday you engineer this into your life and however many years from now they want to start passing, agendas and you don't comply, they could just slow the spigot in how much they're willing to pump this up and let you hurt a little bit. And that's why we're saying take control of your own assets, take control of your own investing. Don't rely on single point failure. I don't think these people are sitting around twirling their evil mustache doing that right now. But if this is where you have all of your wealth, is in the markets that require the central planners to have this type of debt based policy, then you are not diversified. You're diversified in one thing, single point failure. So I'm not saying don't be in the markets. I'm saying that if that's your only thing, you could spread it around stocks, bonds, mutual funds, whatever. You are not diversified. You're exposed 100 to the percent to the financial plumbing in the market. Therefore, if somebody ever chooses to to change your environment to get you to do something they want you to do, you'll probably comply, or a number of people will. So what we're saying is build in real assets that real people need in the real economy that are decentralized, so you don't have those single point failures. And that's why we say economics ties to freedom. And we could get further into that, but I think that'll kind of wrap up what we're trying to cover here. Um, so just think about your own investing portfolio, understand the data, look at where we're going and say, okay, what's likely to happen? Ask yourself what you can do about it and if you can make any moves to better position yourself as we go into things. If you look at the last 3 or 4 years, well, a couple, 2 or 3 years, if we sat here and just named off a bunch of things that the central planners have made us do as it relates to freedom and freedom of movement and choice and things like that. Got to be careful what I say because I don't want to get censored on YouTube. But if you start to look at that, if we just said that a few years ago, everybody said, "Ah, Jay, you're crazy. That's tinfoil hat talk." And if you look at it now, it's happened. And that's my point, is we had to comply. If you didn't comply, you lose your job. They put the squeeze on you. They change your environment. It so what I'm saying isn't made up. This has been going on since the start of human history, and as more and more power and more of the needs get shifted to the supply pipelines that originate from these central planners, politicians, people that are in it for their own self-interest, you become more and more exposed. And that's the piece of the freedom, or that's the freedom message I want people to understand, so we can all try to migrate away from that. Because if we all take enough moves together, that's the point of joining our community, so we can stay informed, we can collaborate, we can network, we can find opportunities together to start acquiring decentralized assets. It's just a great hedge against many, many things, and that's what we're trying to make people aware of. So if you like this video, or if you found this valuable, like the video, share it with some friends. Let's grow the community. Send the email to community@code3assets.com, and let's get more people working together, stop the divisiveness, and kind of hedge our bets here a little bit. So anyway, we'll see you on the next video. Thanks for watching.